Hello, my name's Nick and I'm a helpful British person. For some people, retirement can be more complex than when you had money coming in every week from a job. Very few people are set for life when work ends, but you have to keep the money coming in every month to pay your bills, live your life, even if your cost of living has decreased. Also, retirement tends to be a time where lots of other things are happening. Your kids moving out and starting families of their own. You might have to sell your home, move to a new town or city. Any of these events can drastically affect the amount of money you earn or save. To make sure that you have a happy and healthy next chapter, in this video we're going to be talking about 10 strategies to keep the money coming in retirement and make the most of what you've got. Social Security. If you're at least 62 and have been paying into Social Security through your paycheck for at least 10 years, you're eligible to receive benefits that are based on 35 of your highest paying years in the workforce. Retirement accounts. You can take penalty-free withdrawals from your retirement plan, your IRA or 401k when you turn 59 and a half. Depending on how these plans are set up, these will come to you in a lump sum, annuities over a fixed period or over your lifetime. Interest-bearing checking accounts. You should have the bulk of your savings in investment accounts because of the chances of a higher yield. But you can have some cash stowed away in a high-bearing checking account. Many banks offer checking accounts that offer interest rates that are competitive with traditional savings accounts. So you can earn interest income while retaining greater access to your funds than you would with a federally regulated savings account. Short-term CDs. Certificates of deposit generally earn a higher interest than savings account, and because their rate is fixed for the duration of the CD, they tend to be more stable than bank accounts or stocks. The trouble is though that your money is tied in for the duration of the CD or you're responsible to an early withdrawal payment. Try to find yourself a high-yield CD with low to no minimum deposits for 1 to 2 years to make the most of this option. Annuities. Collect payments from investments or other permanent life insurance policies. This option is particularly helpful if you outlive the assets in your retirement savings accounts. Spouse or partner income. If you're retiring before your partner, you can plan to reduce your living expenses and live primarily off of a single income. Conversely, if your spouse dies before you, you may be eligible to receive their Social Security or retirement benefits or a lump sum payment from their life insurance plan. Part-time employment. Many retirees continue to work in their retirement, although with their Social Security benefits and their retirement plans and with reduced cost of living, you don't have to earn as much money as you did from your job. See if you can reduce your hours at your current employment or find simpler part-time work or work for yourself by starting a business or going freelance. Rental property or property sale. Rental properties can generate income quickly compared to other investment opportunities. So, run the business yourself or have a managing company that can deal with the renters and the maintenance. Purchasing a property to improve and then flip is also a really good short-term way to earn out of property investment. Home or property sale. Leaving the workforce could mean concurrent life changes for you, such as leaving your business or moving to a new location. Proceeds from selling your house or your business could significantly increase the amount of funds in your retirement account. Reverse mortgage. If you're 62 and own all or a significant portion of your home, you can borrow against your home's equity for a lump sum, monthly payment, or a line of credit. A reverse mortgage is a type of debt, but one for which you don't make payments. Instead, the balance becomes due when you sell your house or at the event of your death. This may not be the right option for everyone though, so make sure you talk to an advisor before you decide to proceed. How to stretch your retirement savings. How much income your retirement savings generate depends on how much you earn and save. But no matter how much you've saved or what you earn in retirement, there are some smart strategies you can make to help stretch every dollar. Here are some popular ways for you to make the most of your money. Follow the bucket plan. The bucket plan divides your savings to ensure security while letting other funds grow. You have 3 accounts. The first one is a savings or a money market with 3 years expenses in cash. The second is bonds for modest interest income, and the third is stocks for faster growth, although that of course does come with more volatility. You then funnel your interest earnings from the later two buckets into the first to replenish when needed. Adhere to the 4% rule. Financial advisors recommend this withdrawal method because it ensures that your money lasts through your retirement. From a classic portfolio of 60-40 stocks to bonds, you withdraw 4% of your holdings every year, plus a little bit extra in line with inflation. Buy Treasury inflation-protected securities. These US government bonds protect your investment against inflation by increasing or decreasing the principal according to the Consumer Price Index. A fixed interest rate is then applied to the greater of the original or the adjusted principal twice a year. Use tax deferred accounts strategically. Ease your tax burden in retirement by putting your investment in the most advantageous accounts. For example, bonds are taxed at the normal rate, so you might want to put those into an IRA or a tax deferred account. Dividends from stocks can be put into a taxable account like a savings account. Invest in dividend paying stocks. If you want to earn regular income from your investments, then invest in stocks, mutual funds or exchange traded funds or ETFs. These stocks offer a portion of a company's profits each quarter. If you invest in non-dividend stocks, then you have to sell shares to earn from an increase in value. Delay your retirement, or at least your benefits. If you're 70 and you can continue to work, or you can live off other assets or income, you can significantly increase your amount of Social Security benefit. Every month after your retirement age, which is 66 for baby boomers and 67 for younger generations until you're 70, the amount of your Social Security benefit that you receive increases by a small percentage. If you delay receiving those benefits until you're 70, you can get 132% of your full benefit amount. You have a lot of options for generating income in your retirement and stretching your money as far as it will go. Unfortunately though, there is no one strategy that will work for everyone. It really does depend on your personal circumstances. So talk to a financial advisor and they'll be able to look at your situation and offer financial plans and investment vehicles that will work for you. Be sure to visit altruist.com/learn and subscribe to receive weekly videos and articles to help you become a pro with your finances.